Welcome back. The fourth quarter GDP is due out in about an hour. Growth is expected to be 2.5%, according to Thomson Reuters. This after Federal Reserve Chairman Jay Powell testified in front of the House Financial Services Committee yesterday on his outlook for the economy. Watch.
It does feel to me that the next couple of years look quite strong, and you should see strong demand from consumers. You should see businesses investing, and I would expect the next 2 years on the current path to be good years for the economy.
Joining us now, Wells Fargo Investment Institute Senior Global Equity Strategist, Wren. Scott, it's good to see you.
Hi, Maria.
Next couple of years look strong, good growth. What does that mean to you in markets?
Well, for us, I think strong is certainly a relative term. Politicians always want to seem to pump up the growth very high. But if we saw something in the 2.5, 2.8, maybe toward 3 type of range, I think over the next couple of years, inflation stays reasonable. I think stocks can do well in that kind of an environment.
How come markets are so nervous about this?
Well, I would argue that 2018 is all about the central banks and particularly the Fed. We've been on a 10-year monetary policy experiment. It's coming to an end. In any normal cycle, the Fed usually has trouble backing away. This one's going to be more difficult. So when the market starts finally coming to grips that we are going to have 3 hikes this year, which I think they have, when in 2017 the stock market, I think, was mostly in denial. It's some uncertainty. Jay Powell talks yesterday, as you mentioned, talks, maybe 4. That's a problem. We've argued that 3 is okay, but anything over that is a headwind for the market.
You said reasonable inflation number. What is a reasonable expectation of inflation?
Well, Jason, I tell you, we are, let's say we got out of 2017 with 2.1 CPI type of number. Our number this year is 2.4. So inflation is moving up. That's way below the longer term average. Of course, personal consumption expenditures, PCE, has been stuck at 1.5%, way below where the Fed wants to see it. So, I think the Fed's probably in the end going to let the economy run a little hot. I mean, they've been trying to get inflation for 10 years. They have not been successful. They don't want to just choke it off too quickly.
But when you talk about the central bank, our central bank, unprecedented monetary policy over the last 10 years, the interest rates could get away from them. I mean, they can move on the short end, but in terms of the longer end, and as these Treasury and mortgage securities roll off their balance sheet as they try to reduce it later this year, that's the great unknown. You don't really have, because again, the market could take over, and you've already seen that start to happen with longer-term interest rates. I mean, they're only at 2.91% at the close yesterday on the 10-year, but nevertheless, that's a major worry. That's why people are so fixated on that.
Well, I think they are, Dagan, and really, we're in uncharted territory. I mean, we've never had to roll off this much off a Fed balance sheet, so that's more uncertainty. I think any news that has to do with wages, with employment, with inflation, with the Fed, the market is going to react meaningfully, probably, in one way or the other. Yesterday, it was Jay Powell's comments. I think on March 9th, when the employment data is released, the single most important data point this month, or in March rather, I would argue, is what did average hourly earnings do year over year. If that is less than 2.9, let's say it's 2.6, I think the market will rally on that. If it's 3 or 3.1, it's probably going to be an ugly day.
Yeah, because those are 2 important dates. March 1st, we get the PCE indicated. March 9th, we get the jobs number with the wages. We'll be watching that. Real quick, what are you telling clients to do right now? Would you put new money to work here?
Absolutely. I think that what we want our clients doing, industrials, consumer discretionary, healthcare, financials, we want them buying on the dips. We've been pounding the table on this thing. Now, it came and went pretty quick between February the 2nd and February the 9th. It went down a lot, and people were cautious because of the speed it went down. We want our clients in this market, though.
All right. We will leave it there. Scott, great to see you.
Thanks, Maria.
Thank you so much.